But as far as me mentioning any one specific product or another, my information will be at the very end of this slide set. You can reach out to me via email or call me directly, and we can talk about your specific scenario. So we'll get started. As you heard me say, I am a retirement income specialist, and my specialty here is working with our membership and planning for retirement. And when we sit down with people, oftentimes, it depends upon where they are getting ready for retirement. Either they're about to go into retirement due to many of the factors in the labor market, or they're 5 or 10 years out, or they really don't want to go into retirement. You want to have a plan for continuing to work after you turn a certain age. We talk about the different facets of how your life will change. We talk about Social Security. We talk about investments. We talk about savings. But one of the things, as Matt said, that people don't want to or have a hard time accounting for is planning for the possibility of having to utilize long-term care services. Most of the time, in my experience in doing this, is that the membership or the clients that I end up working with in their different markets here in North Carolina and all over the United States are more often open to having a discussion about long-term care if they've had a parent involved in it. That seems to open up the dialogue even more. And I think it's important. And I think tonight, as I go through these slides, really want you to be able to understand the basics of long-term care, how it can affect you, and how it should be part of your planning. And we can talk about the different planning pieces as well. So we'll go ahead and get started. And it could be in your future. Statistically, the Department of Health and Human Services says that more than half of us over 65 will need long-term care. Now, think about it for a minute. There are 10,000 people a day turning 65 in this country, and that will continue until about 2035. So think about that and the need for long-term care facilities in this country. I know here in North Carolina, between Winston-Salem and Greensboro, there are, especially in the Kernersville area, if you are familiar with the state, you're seeing properties pop up all over the place. Here and down in the coast, where people can transition from their homes into these types of facilities sometimes. So what is long-term care? It's ongoing services and support that you may need because of a chronic health condition or disability. Now, how do you qualify for long-term care? I'm going to use a term that you may have heard of or may not, but physicians use this in qualifying patients for long-term care. It's called activities of daily living. And there are 6 of those that carriers and physicians look at to qualify you to be able to utilize your long-term care policy. And those 6 activities of daily living are bathing, dressing, eating, transferring. That's a formal term of being able to go from point A to point B in a room, point A to point B in a room without needing any help. Toileting, going to the bathroom, and then continence, and that has to do with bladder and bowel function. Now, if you're like me, my parents are in their 80s, but I have a father-in-law who's almost 89. If you notice, one of the activities of daily living not listed there is driving. That's a tough conversation that a lot of us, if you haven't had it, you may end up having to have it, about older Americans as we live longer, being able to have the functionality to be able to drive. And again, that's not one of the activities of daily living. So I guess the bottom line is, could you be in a nursing home and drive? And the answer is yes, because it's not listed there. And care can be provided if you need it in a variety of settings. It can, and what a lot of folks I've talked with would prefer to do is have care at home because they're more comfortable there. And that talks about it here, assisted living facilities. There are adult daycare centers now where you can have, if you needed this type of facility, you can have a child or a caregiver take you to this adult daycare center. It's kind of like a day camp, so to speak. You would stay there from 8 to 5 while maybe your children would go off to work, and they would pick you up on their way home. And then there's the standard nursing home that many of us are familiar with. This is the thing, this is the slide that scares people. When you look at what the cost of nursing home care is doing here in the United States, it's getting expensive, folks. Many of you have experienced it. I've had an aunt in a dementia unit down in Fayetteville now for 11 years. She has gone through over $700,000 in savings, is now qualified for Medicaid, and is in a Medicaid nursing home. My aunt the same aunt just turned 90 last week. So she was, this is a case that's outside the norm. Generally, statistics show that women oftentimes need long-term care more than men. And the average length of staying in a long-term care facility is about 4 years before the patient ends up passing away. Nonetheless, if you take that first figure, $82,125, and multiply it by 4 years, you can see that it could take a big chunk of money to stay in a place that you would feel comfortable having your parents or either you in. And this is in today's dollars. This isn't, or not 2019, this is in 2021 dollars. So what we're continuing to see is healthcare cost, especially the out-of-pocket piece for us, continues to go up here in the United States.
Michael, I was about to ask those figures there, is that including what insurance will cover, or is that just the hard cost, just looking at it without insurance or anything like that?
That's just the hard cost, unfortunately, without any insurance, without any long-term care insurance whatsoever.
Wow.
So how will you pay for it? And that's the big question that we sit down and talk about when we do the planning. You know, if you're high net worth, you may say, you know what, I want to roll the dice and I can pay out of pocket, you know, 8 or 9 grand a month, which ends up being over 100 grand a year, will not affect my long-term retirement plan. For many people, that would be devastating to them. You can rely on government programs such as Medicare and Medicaid. And we're going to go over some of the realities of what those types of programs will and will not pay for in just a minute. You can buy long-term care insurance, which is what we get into big discussions about when we sit down with clients. And those are the 3 biggest areas where you can look to have some type of protection if you have to go into long-term care. So paying for it out of pocket, it basically gives you carte blanche to go anywhere you want to go. Many people I'm seeing now are moving into these, it's called continuous care retirement communities. And when you move in these types of facilities, you do have to be a certain age to get in there, right? But you can step, as your health deteriorates, you can step maybe into assisted living and eventually into long-term care. You know, you've got different phases of retirement. They say the 60s is the kind of go-go type of retirement where you're still got really possibility of still really having good health and traveling and being with your kids or your grandkids or going all over the place and experience some things you put off. The 70s, you may slow down a little bit. And then the 80s, you may slow down a lot. Remember, the average age now for a couple that's 65, projections show that couple's probably going to live to be 84 and 86 years old. So you've got some longevity here that you really need to look at. So paying out of pocket is a definite option, right? But you got to be able to liquidate the assets quickly. If you've got a big stock portfolio and you've got a lot of capital gains taxes and you liquidate that, that could force you to have a big tax hit. Also, if you have legacy plans for investment portfolios or land or beach houses or businesses, and you have to liquidate those to provide care for yourself, that can have a huge impact on a taxable liability to yourself. And you want to get that done. You want to get that done, and you may end up having to do that again at a time that may not be the best for you. Anytime you liquidate assets in retirement accounts, that does count towards taxable income for the year. So, and it can also affect, again, your ability to pass on those assets to your family. And then if you run out, just like my aunt's has had to do now, who was paying out of pocket originally, you have to file or take a look at family members or what your government options may be. Now, I have talked to people about this because I was really wary. You probably have seen some commercials from some actors about looking at long-term care, paying for long-term care with reverse mortgages. This is a viable and can be a very good option for you to do that. So I've helped a couple of clients do this. And here in the state of North Carolina, you are actually able to take out a reverse mortgage, even if you have a mortgage still on your home. But it's very important to know that once you start go down this process, you really do need to stay in your home and have be able to have that as an asset. You don't make any mortgage payments here, and your loan is repaid when you vacate the home. Here in the state of North Carolina, in order to understand what a reverse mortgage is, there are special designated areas within the state that you have to go to complete a course. You have to pay for the course and have a certification by a counselor to say that you understand all the ins and outs of your long-term care mortgage, or excuse me, your reverse mortgage. So but that is an option. That is an option. It's also an option for folks who may end up outliving their assets, but I don't think it's something you want to think about lightly. And especially if there's two of you, really, really do need to do have a good conversation with your financial advisor about if this is the right choice for you to make.
Does anybody, I just want to pause right there, Michael. Does anybody have any questions about that piece, about the reverse mortgage at all? If you do, you can raise your hand. If you're on Zoom, if you're on Facebook, just shoot me a comment there in the comment section. One of the questions I had, Michael, so if you were doing the reverse mortgage and you said that it's paid when you vacate the property, what happens to that property? Does the property become the property of the state, or how does that all work?
It's sold by the mortgager that takes out the long-term mortgage on your home.
Okay. So, okay.
Yeah, on the reverse mortgage. I keep saying long-term, on the reverse mortgage. Yes.
Reverse mortgage. It does become the property of the mortgage company.
Yes, it does. Okay. Yes. Okay.
We can go forward.
Okay. So paying for Medicare, and this is probably one of the biggest misconceptions about what Medicare will do and will not do. And for many of you that may not be aware, there's a proposal to reduce Medicare to qualification and to lower it from 65 down to 60. We'll see if that happens, but what many people don't understand is that Medicare Part A pays for your hospitalization. Medicare Part B is what you do when you go to the doctor, but that only covers 80%. So it would only, you would still have to get a Medicare supplement to cover that. But as far as long-term care, Medicare pays after a 3-day hospitalization. The first 20 days, they're going to pay just about the full cost if you need skilled nursing care. Day 21 to day 100, they pay about $150 to $160 a day, which will take care of part of that. But after day 100, you're kind of on your own, and it doesn't pay for any custodial care that you may need as well. So that I want to make sure that people understand that Medicare will take a piece of it. But again, what's 4 years times 365 days is about 1,450 days. That comes up way short of covering what you would need in case you need the care. And home health care benefits or home health benefits are limited. Medicaid, which is the program for indigent in the states, it's a joint program between the Fed and the state. A lot of people think it's a state-only program, and that's not true. The federal government does kick in monies to this. And it is actually right now the largest public payer of long-term care services. It is really, it used to be that it was a lot easier to get Medicaid to pay for your long-term care, but it's means-based now, and there are limits where you can receive care. Medicaid will not cover your care in the home. You have to be in a facility. One of the things too, if you or a parent This is an exception to this, not in the slides. If you are a parent, one of the things that's very important to know is if your parents have military background, because they can utilize the VA for some of their long-term care services in case they have to do that. So the way Medicaid eligibility works is each state, even though it's got federal dollars, they do establish their own backgrounds. And your income must be less than the cost of care. And it's generally, there's a cap that applies. It's 300% of your Social Security benefit. In most states, they will allow you to carry $2,000 in assets, and some assets are not counted. Your house is not counted. One car is not counted. Household and personal belongings are not counted. Term life insurance is not counted. Term life insurance, which if you have life insurance, you know that term life insurance has no cash value. Doesn't say whole life cash value insurance is counted as an asset here. So you would almost have to take that life insurance, if it's whole life, and do something with it, whether it be cash it out or whether it be to make an exchange over to a term policy in order for it not to count as an asset against you. It used to be that you had to get rid of all of your assets 3 years before you went and could apply for Medicaid. And that's not the way it is anymore. It's 5 years. So if you apply for Medicaid, they're going to do a 5-year look back and say how much in dollar assets did you have 5 years ago, and they're going to ask you to dwindle those assets down to basically what you see here. Using these assets can count to purchases. You got to, I think sometimes it's to do this planning, sometimes you need to have an attorney that can help you with this. You can get these assets in trust types of agreements, and you can give them away. I will caution you in giving away assets to adult children or leaving them. I think sometimes it may be better to use trust agreements and trust documents. It's a lot cleaner. I've seen clients do this without consulting attorneys, and what they unfortunately do without knowing is create a very big taxable liability for an asset that they've given away. And it's just because of the cost basis on that asset. That would be something we could talk about in a one-on-one situation, but that is also one of the things being proposed right now by this current administration is on property, especially, there's not a step up in the cost basis. What I mean by that is if you own a home in Highlands, North Carolina, that you paid $300,000 for, and you pass away and it's worth $800,000, that property is left to your children. Their cost basis is $800,000. And so they could sell it for virtually no taxable gain or no tax penalties or paying no income tax, so to speak, on that sale. But the current administration wants to go back to the original cost basis for that inherited property, meaning that those adult children would now have a $500,000 taxable gain on that property, and they would have to pay taxes on that. So that's where some things with Medicaid planning could change a little bit in the future. So and those are the drawbacks. The Medicaid laws can be complex. This is an example of transferring your house to a son or a daughter. If the fair market value is $400,000, Medicaid's going to look back and say, okay, the average cost of this nursing home is $800,000 a month. So they're going to make you wait 50 months because of the cost of getting rid of that home before you have eligibility to go into a Medicaid facility, into a long-term care facility, which brings up another point. If you see these very nice facilities you would want your parents or you would want to go into, and you think that Medicaid will pay for all of those, not true. Many of these facilities have only X number of beds that they have allocated for Medicaid patients. So, and I'm not saying that they can't be, but you might, you do wonder about the quality of care in a Medicaid bed versus a standard bed where someone's paying with long-term care insurance or they're paying privately. So long-term care insurance is when long-term care insurance is probably where most people choose to go to in this scenario. What we try to do is to look at the type of product that best fits the needs for the members of the clients. There are a lot of them out there, guys. I mean, there are different hybrid products now. Your traditional long-term care policy, basically, you're buying a pot of money to cover your healthcare expenses in the future. That's exactly what you're trying to do. And some policies, you can add inflation riders to those, which increases the cost. Some policies, you can share a pool of money with two spouses. Some policies, you can put a lump sum into a policy just for one person. And then there are hybrid policies out there that allow you to pick an amount that you want to cover for both of the spouses, and the benefits can be unlimited. But again, there are all sorts of products out there. There's not one product that's right for everyone. Some products actually do allow you to get your money back. If you cash the policy, if you have the protection, say you're 56 and buy a policy and have that policy for 10 years, put the premium money in there, and then in your age 66 and want your money back, they'll let you do that. But you don't gain any interest on that money either. So if you're putting a lot of money in there and you're not, then that could be a big drawback based upon the rate of return you could get in the market. So you must be of good health to buy a policy. It's based on your age, and most companies do some type of health questionnaire or physical in order to qualify for long-term care. I have gotten this question before, and this has to do because most of the time long-term care affects women than men. If you have a history of breast cancer and you have been treated and you have a clean bill of health for 1 year period after your last treatment, you can qualify for long-term care. It might not be at the same rate as someone that gets a preferred rate, but you can do that. So don't let that scare you. Don't think that you couldn't be or couldn't qualify for a long-term care policy. And again, here's where I mentioned in bullet point 3, the 6 activities of daily living: the bathing, dressing, eating, transferring, toiletry or toileting, and continence. Most of the time, the policies carry a 90-day elimination period. What that means is the policy goes into effect on day 91. And it does that because Medicare will pay some portion of that the first day, from day 1 to day 100. And most of the policies do allow you to have care in the home. They also, if your spouse has elected to provide a lot of that care, these policies provide allowances for respite care. In other words, to bring someone in a couple of days a week to give your spouse or caregiver a break from having to attend to your needs. So you got 5 features really of long-term care: the amount of benefit payable, the benefit period, how long it will last, and on the policies where a couple is sharing a pool of money, for example, say you want to share $250,000 for 42 months, that's 3.5 years. So here's how that would work. Say John has to go into a facility and he uses up $200,000 of the care. Then Mary would still have $50,000 worth of coverage if she outlives John. If both of the couple die and the policy is not used, then the money is lost in that type of scenario of traditional long-term care. But if John passes away and never uses any of the money, then Mary would have that full pot of $250,000 in order to help her with her long-term care expenses as well. How long will benefits begin? We talked about that. The location, does the policy cover in different settings? Most of them will. And then inflation protection. Most of the time, whenever members or clients choose to look at inflation protection, is 3% annually, is how that works. The younger you are, the less expensive the policy is going to be. I think it should be a budgeted item in your plan for retirement. These prices continue to go up. There is a policy out there that will cover a couple, and this carrier does say and guarantees that once you start paying on the policy, they will guarantee that your premium will not go up ever once you start paying on it. And that's a big deal in retirement planning, because most, you get into a budget routine when you're retired. You're looking at more conserving assets and spending out for things you're going to need. You don't want to buy a policy, be in it for 8 years, and then all of a sudden the carrier goes to the state insurance commissioner and says, we need a 20% increase. And that can happen. That can happen because what carriers can do sometimes is underestimate their claims paying power, and they'll look at their current policyholders and understand they'll need to have a rate increase from them. But there is a policy out there with one of the carriers that does guarantee once you start paying for your long-term care insurance, your premium will never go up. So just know that's out.
How Michael, how young is too young to get started on this? Like what would you recommend?
Matt, that's a good question, and I do get that question a lot. I think anyone north of that half-century mark needs to start thinking about this as part of their retirement plan. I really, really do. It used to be just several years ago that companies were offering long-term care insurance to their employees, much like group health and group life. It was an additional benefit that a couple or just the employee could participate in and buy at a tremendous discount of what's available on the market. But that's actually gone away. The only carrier that I know that used to offer that has stopped doing that for any new businesses.
One question that we had come across is, does your medical history or your medical records, do they review those? Does that play a role in that long-term care insurance about getting covered?
It does. Yes. You go through a questionnaire that either the carrier or the like I ask, and I'm required to do that. And I'm required to ask a pretty extensive medical questionnaire about your health history. There are going to be some things that will disqualify you from getting long-term care. And then you'd be surprised, some things may not. What I always try to do is to pre-qualify the client to make sure that there's no need going through the process if you wouldn't qualify. But then there are some instances where you may think that you are not qualified, and you absolutely do. So I think it's all a case-by-case basis.
Okay.
Okay.
Perfect. Yeah. Thank you.
All right. So also, you can get some federal tax deductions for paying long-term care premiums. And there can be some state tax deductions as well. I also tell folks, if you have a health savings account, you can actually pay for premiums for long-term care out of your health savings account. As pre-tax dollars you're contributing to and you get to pay, just like you pay for maybe glasses or dental care or something that your policy won't cover. You can do that through an HSA for your long-term care premiums. You've got and this is what I was talking about, these combination policies. Some of these do not require a medical questionnaire. Most of them do. I will tell you, my experience has been that most of them do. Again, there are a lot of different options out there. There's no one right way to do this. I think the biggest thing you've got to understand is you should think about planning for it. It should be part of one of the 5 or 6 pieces in your retirement plan. I have good friends. There's a 9-year difference in their ages, and what their retirement plan for long-term care has been is their daughter is a nurse, husband and little girl live down in Wilmington, and they've agreed, and they're adding on a kind of a tiny house onto their daughter's house. In case anything happens to either one of them, the daughter can care for them right there. So they've added on an adjacent 800 square foot connected by code to their house, tiny house, onto their property, so that they can have the daughter can provide long-term care. And that may be great for somebody. Again, it just depends on your individual situation. But begin planning when you're healthy. That's the biggest thing. It's just like trying to get a policy once you have a catastrophic illness. Not going to do it. And you want to have enough time to plan for Medicaid, especially. My big thing is, especially if your children are out of state, they're not close to you because of their career. I don't think any of us want to be a burden on anyone. I know I don't on my 3 adult children. And so that's why you do the long-term care planning.
It seems like that's the most important thing, is to think about that before before you get to that point. Before you get, having to you're going to the doctor more, you're going to the hospital more. It's one of those things where you have to do that earlier on. So that's
And Matt, everyone should look back at your family history. Ask your parents, ask your aunts and uncles, see what's happening with them. If they have a history of any debilitating diseases, then who knows what could happen to you. I don't, you don't, but there's some things out there that are predisposed to you that could have a definite impact on your long-term care planning.
That's true.
I want to just mention a minute that in pricing these products, insurance companies, be careful of what you get. Some of them have gone under scrutiny, again, because of price increases. Anytime a carrier asks for a price increase, it has to be approved by the state insurance commissioner's office. Many carriers initially underpriced their products because they priced them like life insurance policies. And the way they do that is, if you have 100 people in a pool that buy a life insurance policy, they look at statistical data to say, okay, how many people will still be involved in that policy in 5 years, 10 years, 15 years down the road? Well, they priced their long-term care policies like that. What they found out was, with life insurance, where you may start with 100 people, 15 years down the road, you may only have 50 people still in the policy. With long-term care, you start with 100 people, 15 years down the road, you still have 90 people in the policy. Big difference there. And so that's why they've gone back and said, oops, we didn't plan for these persistency rates, that's the formal term, by the life insurance companies, and they've gone back and asked for insurance premiums increases. Now, you can stop the policy right there. You still may have some care built up, but I would bet you, based on what I have seen, it wouldn't be enough to get you into an assisted living facility for 6 months.
Would knowing that that situation occurs, are they required by law to let you know in advance before this? I'm guessing you would know before they do have that increase.
They generally will send you a 30-day notice of a premium increase. That's all they're required to do, is about 30 days, just to let you know.
One of the things that I just you were mentioning, maybe this is a conversation we have one-on-one, but like any recommendations for, I know there's tons of products out there, and this may not be a question that you can answer, but any one that you would recommend that would be the best that you've seen on the market out there right now?
Matt, what my wife and I did may not be right for another couple my age,
right.
Or it may not be right for your parents, or maybe it not be right for people listening to this program this evening. I think the best thing to do is to sit down and have a conversation about it. I think the worst thing you can do is think that it couldn't happen to you.
Absolutely.
Often, right now, my wife has a 51-year-old cousin who is in an assisted living facility because of a stroke 3 years ago up in Elkin. And that's and it comes from a very affluent family, but those you think about how long she's already been in a facility for 36 months and with a stroke, and I think that facility is running 6,500 a month for 36 months already. That's about what, 200 grand already,
Yeah,
and there's a good chance that she could live a good bit longer.
right.
So again, I think part of what the biggest part is having open and honest dialogue about your needs and your budget in retirement, and not thinking this can't happen to you, and making sure that you're prepared in case it does. That's the
Yeah,
biggest.
that's true. That's true.
So this is the end. We went through that pretty quickly, I know, this evening, and Matt, I appreciate you moderating this. For the folks on Facebook that are listening, this is my information. My direct line is listed here as well, and to our website, my email is listed here. If you'd like to have a conversation, into our members who are listening as well, about this or any other type of your aspect for your retirement income plan, feel free to reach out to me. Everything we do is really personalized here. We are here to serve our membership and our clients, and we never develop plans that aren't specialized. There's not a one size fits all strategy for discussing long-term care needs or any types of investment solutions. In fact, in planning for retirement, the investments really are down the road. The really, it's everything that evolves around that centerpiece. It's your Social Security claiming, your in Medicare, and something like retirement income planning, and a lot for long-term care. So I want to thank you. Thanks, Matt, for having me this evening. We like doing these. Hopefully towards the end of the fall or towards the beginning of the fall, we'll be able to get
Right.
back and do some of these live out in our different areas of our for our credit union membership, where we can have a little bit more one-on-one. So thanks
Right.
for having me this evening. I really
Thank you. I really appreciate it, Michael, and thank you all for viewing through Zoom and on Facebook as well. We really appreciate it. Again, reach out to Michael. He's a wealth of knowledge, and is here to assist you. And we also have Fitz McMurray, who's also a part of the investment solutions group down in the Charlotte region. We are lucky to have these two gentlemen and this team of people here at Piedmont Advantage to, like he said, serve our membership and serve them well. So please don't hesitate to reach out to Michael or through our website, as you see there. Please feel free. That's what we're here for. We're here to help, and we're here to make life a little bit easier for you. So thanks again. If you have questions, feel free to send those over still. We have people that are reviewing the comments on Facebook, and also emails as well. So we look forward to hearing from you. Michael, thanks again. Appreciate it. And we look forward to hearing from you again soon.
All right. Take care, y'all. Good night.
Bye-bye.